Welcome back to the Investment Diary. Today, we have a very important situation unfolding in the design software space, specifically regarding the massive shift we have seen in the market over the last few days. If you have been watching the tickers this week, you already know the headline. Figma has just dropped again, breaking aggressively below the $25 a share mark. Panic is in the air, and Wall Street is hitting the sell button hard. But you already know how we do things here. When everyone else is panicking, when the headlines are screaming that a business is dead, we slow down, we look at the numbers, and we figure out what the business is actually worth. Here is my fully integrated, data-driven breakdown of what is really happening with Figma, how it compares to Adobe, and where the true value lies. Now, if you have been following this channel, you already know my golden rule. I do not like investing in IPO stocks. Why? Because IPOs are fundamentally designed for insiders to exit. When a company goes public, you are almost always buying into a perfect storm of danger. Peak hype generated by the investment banks, retail investors chasing the fear of missing out, and heavy insider selling waiting in the wings. That combination usually destroys the stock price in the first year. But here's the key difference right now with Figma and why it is suddenly on my radar. The lockup period is over. Figma went public in July of 2025. We are now in March 2026. The 80-day lockup expirations have passed. The bulk of insider selling from venture capitalists and early employees is likely already done. And this matters immensely, because now the price action is no longer distorted by millions of shares of forced scheduled selling. It is starting to reflect actual market valuation. Let's be clear about the magnitude of this drop. Figma didn't just dip, it collapsed. Back when Adobe tried to acquire them, the valuation was floating near $20 billion. At the peak of its pre-IPO and early IPO hype, the implied valuation stretched toward the $40 billion to $60 billion range, depending on the day's multiple. Today, the market cap is hovering around $13 to $14 billion. That is a massive reset. And this isn't random volatility. What we are seeing is 1. Multiple compression across the entire software sector, 2. Growth expectations resetting to realistic levels, and 3. Reality kicking in regarding the competitive landscape. So what triggered this specific violent drop below $25 this week? 2 words: Google Stitch. Google just released massive updates to Stitch, their AI-native UI design tool, and suddenly the financial media narrative became AI will replace designers completely and Figma is a dead company walking. But this is where the market is getting incredibly lazy. Stitch is not a brand new concept that just dropped out of the sky. I have personally been using it for months for my own app building. Yes, it is good. The UI generated by the underlying Gemini models is genuinely impressive. It is fast, clean, and efficient. Good tools don't kill workflows. They plug into them. Stitch is amazing for generating a quick landing page or an MVP mockup from a text prompt, but will it replace an entire enterprise design team and kill Figma 100%? Not necessarily. Figma today is not just a digital drawing board. It is infrastructure. It is the centralized hub where designers collaborate in real time, developers hand off and inspect code, massive enterprise teams build and maintain complex design systems, and more importantly, it is deeply embedded into the corporate ecosystem. You do not just replace that overnight, especially not in Fortune 500 enterprise environments where entire design languages have been built over years on top of Figma. The switching costs are astronomically high. Furthermore, Figma is not fighting the AI wave. They're already integrating AI deeply into their platform, allowing it to connect across different models. That is exactly what you want to see from a platform business. Let's talk facts, because this is where the emotional sellers are completely off base. Let's look at Figma's latest full-year 2025 numbers. Revenue, $1.056 billion. Growth, 41% year-over-year. Q4 growth, 40% year-over-year. Cash flow, Positive free cash flow, though still GAAP unprofitable due to stock-based compensation. And looking forward to 2026, analysts are expecting revenue in the $1.36 to $1.37 billion range. This is not a dying company. This is a high-growth platform that is still scaling aggressively and generating real cash. Now, let's run a proper discounted cash flow analysis. And because we demand a margin of safety on this channel, we are going very conservative. Here are my highly conservative assumptions. Growth, 12% for the next 5 years, a massive drop from their current 40%, then tapering to 8% for the next 5 years. Free cash flow margin, stabilizing at 28% as they achieve operating leverage. Discount rate, 10%, reflecting the higher risk of a growth tech stock. Terminal growth, 2.5%, roughly matching long-term inflation. Under these pessimistic assumptions, the fair value comes out to roughly $30 to $33 per share. With the stock currently trading completely washed out below $25, we are looking at a 20 to 25% discount to intrinsic value. And remember, that is a low-growth scenario. If Figma maintains even mid-teens growth, that fair value easily moves into the $40. At current levels, I think Figma is finally entering attractive territory. You are no longer paying for the IPO hype or the venture capital markup. On the other side of the ring, we have the undisputed heavyweight, Adobe. And this is where things get truly fascinating. Because Adobe is the complete opposite of Figma right now. This is not a growth at all costs story. This is a cash flow machine, yet its stock has been suffering a slow bleed because the market is treating it like a legacy dinosaur about to be replaced by text-to-image generators. Let's look at Adobe's staggering FY 2025 results. Total revenue, $23.77 billion. Net income, $7.13 billion. Operating cash flow, over $10 billion. Growth, 11% year-over-year. They continue to boast massive 90% plus gross margins, recurring subscription revenue that acts like an annuity, and a relentless, highly aggressive share buyback program. They retired nearly $12 billion in stock recently. This is a highly profitable, dominant company that is practically printing money. Furthermore, their enterprise AI offering, Firefly, provides legal indemnification for corporations, a massive moat that open-source AI models simply cannot offer. If we run a DCF on Adobe, we can be just as conservative. Growth, 6 to 10% moving forward. Margins, sustaining around 30 to 35% free cash flow margins. Discount rate, 9%. Slightly lower risk premium than Figma due to their established dominance. This outputs a fair value in $150 billion to $180 billion range, which is roughly where it trades today. It is fairly valued to slightly undervalued, but heavily de-risked. Here is what is so fascinating about the current design software landscape. The market is getting both of these narratives wrong. Figma is being priced like it might fail completely tomorrow due to Google Stitch. Adobe is being priced like it's already an obsolete relic about to be replaced by text-to-image generators. Neither of these extreme narratives is accurate. The uncomfortable truth for Figma bears is that Figma is deeply entrenched. The uncomfortable truth for Adobe bears is that Adobe makes too much cash to die anytime soon. Figma's absolute best-case scenario over the next decade is to eventually become the size and scale of Adobe. But Adobe is already there. They're profitable, dominant, deeply integrated, and generating billions in cash today. That asymmetry in risk and reward matters when building a portfolio. So, what do you do with this information? It comes down to your portfolio strategy. If you want stability, massive free cash flow, and predictability, Adobe is the clear better choice. It is a value-conscious tech play. If you want higher upside, platform expansion, and a leveraged play on collaborative AI, Figma becomes incredibly interesting at these sub-$25 levels. Because the IPO lockup is finally over, the forced selling pressure has exhausted itself and the valuation has compressed to a highly reasonable level based on my DCF. I am officially opening a starter position in Figma under $25. At the same time, I am watching Adobe very closely and adding to my position on any broader market weakness. Let me leave you with this final thought. AI is not killing the design industry. It is expanding it. Because tools like Google Stitch are lowering the barrier to entry, the sheer volume of digital content and applications is going to explode exponentially over the next few years. And when that volume explodes, what happens? Enterprise teams will desperately need tools to create the assets, platforms to manage them, systems to collaborate on them. Figma owns the collaboration and the developer handoff. Adobe owns the deep asset creation and the legal safety net. Both of these companies are positioned to benefit from the AI expansion, not be destroyed by it. Right now, the market is reacting emotionally to shiny new headlines, but the numbers tell a very different, much more grounded story. Figma is no longer a dangerously overpriced hype stock, and Adobe is certainly not a dying company. When you see this kind of massive disconnect between media narrative and fundamental cash flow, that is exactly where the opportunity lies. As always, this is just my personal investment diary. I share my models and my logic, but this is not financial advice. You must do your own research, run your own numbers, and understand your own risk tolerance before allocating a single dollar. If you found this deep dive helpful and appreciate the fundamental, numbers-driven approach, please hit that like button. It really helps the channel out. Make sure you are subscribed so you don't miss the next analysis. I want to hear from you in the comments below. Are you taking advantage of this panic to buy Figma under $25, or are you sticking with the cash flow safety of Adobe? Let me know your thesis. See you in my next diary.